David, really appreciate it. Listen, if you said a quarter point, I might even be on board. But a half point?
Kelly, I think we learned a lot in the last intermeeting period. We learned a lot about where tariffs are headed. We learned a lot about the rebalancing that this administration wants to take on, which is potentially disruptive in as big a way as we've seen. We just went through probably the most complicated April of my career and came out reasonably unscathed in the end, but it certainly was touch and go there in the second and third week. I think we have a lot of businesses expressing the word uncertainty at the Milken conference, which I just left. And I think it's a time where you can move a little bit back toward a neutral policy. I think you've got all the information. One of the reasons that I think we were all waiting a little bit is we didn't know the priorities and how aggressive this administration would move. And clearly, they moved very aggressively on tariffs, and they moved very early. So I think we need to think about that when managing the downside.
So in other words, you think the economic hit is actually going to be so large that a half-point cut is necessary to more or less support the economy?
I think it's a risk management. You know, Kelly, you always catch me in these because I'm really not a believer in talking about what I think the Fed should do. I always try to tell our clients what I think they're going to do. You put me in the position on this committee to talk a little bit about what I would do if I was in that position. So take it with a grain of salt. I'm not saying that that's my prediction for the Fed. I don't think they will, but I think they could be quite dovish, and I think they have a lot of reason to be dovish. A lot of the intermeeting movements in inflation expectations related to break-evens came down substantially, and a lot of the sentiment that I've seen with our corporate clients, our CEOs, the companies we deal with, is just pullback. And I think as a Fed, as an FOMC member, you're listening to that. As a Fed president, you're listening to that locally. And I think it's just a prudent risk management story in a position where we know tariffs are one-time hits to the price level. They're not sustained inflation.
What about the ISM surveys where we've seen kind of those prices paid measures be sticky? And again, I'm trying to argue it from a point of what will they do, because I think they all lean, frankly, towards being slightly more hawkish and less inclined to cut rates right now, especially now that the jobs report and the ISM surveys have been okay. I bet they go, why would we take on that risk? They never want inflation to come back again. So I just think, again, kind of from a realpolitik point of view, wouldn't the risk be on the side of hawkish for tomorrow?
I think you could definitely make that case. You can definitely make the case, especially when the Fed kind of sat back in the second week of April, let the 10-year note have one of its biggest weekly rises in 30 years, yields rising more than they had risen since the 1980s. And they didn't really say anything. They didn't seem to care. So I think there is a disconnect between the administration and the Fed. I don't think there's a lot of love lost there, surely. And I think when the president is prodding Jay to cut, it makes it harder for him to do so as well in his own mind. So there's a lot of things stacking up to say the market is probably predicting something more hawkish. So I don't think what you're saying would be a surprise. I think the surprise would be if he actually says, you know what, a lot of what we're hearing out there is a little bit worrying. And yes, the data are okay now. Yes, the consumer seems fine, but we're about to rebalance our fiscal and our trade deficits in a very big way. Right. And if you're a prudent steward of monetary policy and you look at maximum employment and price stability over the long run, there's some real dangers during that rebalancing that you want to mitigate against, and you can mitigate against, and you have the ability to mitigate against.
I think going forward, we need to ask everybody what they would do and then what they think the Fed will do. That gap would be fun to show everybody as well.
That would be fun.
David, for now, thanks very, very much. David Zervos of Jefferies.